Hi everyone. We've dealt with the concepts of Ind AS 115, that is revenue from contract with customers. We would now like to apply that learning with the help of several questions to test our knowledge on the topic. We are provided with the scenario. It says that Talkwell Limited, a telecom company, entered into a contract with eCity Limited. eCity is engaged in generation and supply of power. The contract provides that Talkwell Limited shall provide 50,000 minutes of talk time to the employees of EY Limited in exchange of getting power equivalent to 10,000 units. Generally, Talkwell Limited charges 1 rupee per minute and eCity Limited charges 5 rupees per unit. The question's requirement is you're required to determine how should revenue be measured in this case. Now, friends, what you would like to remember here is the two aspects. The question's requirement is simply about, first of all, if revenue should be recognized, and if yes, then how should that be recognized? Okay. The question's requirement is if revenue should be recognized, and if yes, then how do you measure that revenue? All right. Now, importantly, this is a non Now, the requirement of the question is you are required to determine how should the revenue be measured in this case. Now, importantly, this question has two aspects involved. One is that there is no exchange of cash. It's a non-monetary exchange, right? And then, of course, we're talking about two different sets of companies. One company is basically into telecom services, and the other company is primarily into the power generation and supply thereof. All right. So when you look at this scenario, that is, there's a non-cash consideration. How do you deal with that? Right. The standard suggests that in case the companies are in the same business and there is no commercial substance involved, then no revenue shall be recognized. That's the requirement of the standard, because that would probably allow companies to be able to inflate their business. They are merely exchanging the same thing with each other. So the revenue recognition is prohibited in such cases. However, in our given case, the two companies, which is Talkwell and eCity, they are both into two different sets of businesses. So we can safely assume that the commercial substance exists in the given case, right? Which means that you are allowed to recognize the revenue. So that's the first requirement which is being met here. The question is, how do you measure this revenue, right? Then we go back to the very basic definition of revenue. What is meant by revenue for a company? We say that revenue shall be the transaction price an entity expects to recover in the normal course of business. It's a transaction price that an entity expects to recover in the normal course of business, which is basically it is entitled to receive from the other party. All right. Now, since this contract is a non-cash consideration, we land up using the fair value of the consideration received, right? The very basis of measurement of revenue for us in this scenario shall be the fair value of the consideration received since no cash is involved. All right. So what is the fair value of the consideration for each of the parties? We are provided that Talkwell Limited will receive 10,000 units of power and the fair value of the power or the unit is 5 rupees per unit. Likewise, eCity Limited will receive 50,000 minutes of talk time, which is having a fair value of rupee 1 per minute. That means that Talkwell's revenue should be recognized at 5 into 10,000, which is 50,000, of course. And as far as the eCity is concerned, it's basically going to be 1 into 50,000, which is, of course, 50,000 again. All right. Let's have a look at the formal solution of this. It says that as per Ind AS 115, an entity shall consider the terms of the contract and its customary business practice to determine the transaction price. The transaction price is the amount of consideration which an entity expects to be entitled in exchange of the transferring promising goods or services to a customer, unless it's some money collected on behalf of somebody else. For example, sales tax, right? Now, these considerations may include fixed amounts or variable amounts or a combination of both. Further, to determine the transaction price in which the promised consideration is in a form other than cash, the non-cash consideration is measured at its fair value, which means that for the purposes of this transaction, revenue recognized by Talkwell Limited will be the consideration in form of power units, that is 10,000 into 5, 50,000 rupees. For eCity Limited perspective, it would be the talk time, which is 1 rupee into 50,000 minutes. All right. Thank you very much. Let's have a look at this scenario. It says that Wellbeing Limited enters into an agreement on 1st of April 2018 with a customer for renovation of a hotel and installs new air conditioners for a total consideration of 75 lakh. The services, including the installation of new air conditioners in the hotel, is a single performance obligation satisfied over time. Total expected costs are 60 lakh rupees, including 15 lakh for the air conditioner. Wellbeing Limited determines that it acts as a principal because it obtains control of the air conditioners before they are transferred to the customer. The customer in the contract obtains control of the air conditioners when they are delivered to the hotel premises. Wellbeing Limited uses an input method based on costs incurred to measure its progress towards complete satisfaction of the performance obligation. As at 30th of June 2018, other costs incurred, excluding the air conditioners, are 9 lakh rupees. The question says you're required to determine whether Wellbeing should include the cost of the air conditioners in measure of its progress of performance obligation, and how should revenue be recognized for the year quarter ended 30th of June 2018. Right. Now, importantly, you would like to remember here is that when you consider the input method, an input method takes into consideration the efforts and inputs made by the entity, which is, of course, the seller. Now, this may include, for instance, machine hours, labor hours, cost incurred, or, for example, the time spent, right? As far as the total consideration is concerned, we are provided it is 75 lakhs, which is including the sale of air conditioners, right? And the total cost is, of course, 60 lakh, which is 45 lakh plus 15 lakh here. Again, for the air conditioners. Now, essentially, when you look at the procurement of air conditioners, there is a control with well-being limited to start with, which is eventually transferred to the customer, right? Now, in this case, what are we trying to say? That since the control has been transferred from one entity to another, the the very cost, right, does not really contribute as far as the input method is concerned, right? Which simply means that if I look at my costs incurred so far, which is given to me as 9 lakh rupees. Okay, this is what is given to me. The other cost, excluding the that of the air conditioner, which is 9 lakh rupees, I will be taking this purely as a measure of progress on 45 lakh. All right, which means as far as my other costs are concerned, I shall be taking only 20%. Okay, this 15 lakh is a standalone cost. It's independent of the input method, right? Bringing this 15 lakh as as a part of this total cost would simply inflate my overall completion, and that would of course inflate automatically the amount of revenue to be recognized. So how do we deal with this? We are saying that, right, the air conditioning, the performance obligation with respect to air conditioners, this being a significant portion of total costs, right, should be included without any margin, right? Which means what? Out of 75 lakh, we are saying that the 60 lakh relates to other services and 15 lakh relates to, of course, air conditioning. And of course, so this is my revenue, and my cost of 60 lakh, of course, would be taken at 45 lakhs and 15 lakh rupees respectively. Okay, so when I look at for the quarter ended 30th of June 18, my revenue to be recognized should be on this other consideration, which is 60 lakh into 20% plus the revenue coming out of the air conditioner, right? Which comes at 12 lakh plus 15 lakh, which is 27 lakh. Okay. And as far as my costs are concerned, I would look at 45 lakh into 20%, which is given to us 9%, 9 lakh already, and 15 lakh, which makes it 9 lakh plus 15 lakh, which is 24 lakh, eventually resulting into a profit of 3 lakh rupees for this particular quarter. All right, let's have a look at the formal solution as far as this question is concerned. We are given that Ind AS 115 states that an entity shall exclude from an input method the effect of any inputs that do not depict entity's performance in transferring the control. Okay, considering the above, well-being assesses that whether the costs incurred to procure air conditioners are proportionate as far as the total performance obligations is concerned. Now, this is significant. 15 lakh as part of the total cost is a significant cost, so we will be excluding those straight away. Further, of course, we are given that well-being is not involved in the manufacturing or designing the air conditioning, and accordingly, well-being will conclude that including the costs to procure the air conditioning would overstate the extent of entity's performance, which means that it will adjust its measure of progress to exclude the costs from the measure of costs incurred in the transaction price, right? It's a zero margin as far as the procurement of air conditioners and the transfer of the control thereof is concerned, right? On that basis, the revenue to be recognized will be 27 lakhs, which is, of course, 60 lakh into 20% plus 15 lakhs, and the cost of goods sold would be 45 lakh into 20% plus, of course, 15 lakh. And of course, my profit margin would come at 3 lakh for the quarter ended 30th of June 2018. All right. This is what is mentioned, of course, as a part of the formal solution. Okay. Thank you very much.